All right, today we're going to talk about some commercial real estate with Matt Slobodian from Canada ICI. He's an expert in the commercial real estate market and financing. He's going to tell us all about what's going on today in 2023 September. Let's talk about the market. What's going on?
I guess first of all, Matt, can you tell us a little bit more about ICI and the kind of product that you service specifically, and kind of the markets that you're in?
You betcha. Yeah, no, thanks guys for putting this together. And we're roughly relatively a new player in the Ottawa-Gatineau area. We've been around for just a couple of years, but bricks and mortar we have in the Byron market currently. But just to kind of give you the rough elevator pitch, who we are, what we do. So Canada ICI, we're roughly 30 years young. Headquartered in Edmonton. We have offices across the country, so Vancouver, Edmonton, Calgary, Winnipeg, Toronto, Ottawa, and Montreal. Looking to further expand as we go. So we're a commercial mortgage brokerage. We focus strictly on real estate, so anything that is multifamily, industrial, retail, warehouse, you name it. Basically anything but your single-family home mortgage, we can do. So there's no loan minimums or maximums. We do all types of financing, whether it's acquisition, construction, bridge, term, refi, you name it. Annually, we do roughly $7 billion of loan transactions across the country, and that's conventional and CMHC financing combined. So we have a really good handle of all types of financing, if you will, considered the leaders in the country, actually, in that regard in terms of volume. So how we are able to amass that success is that we have multiple sources of capital, so over 125 lending relationships across the country. So that's that external brokerage process, match a borrower to a lender. Because we were predominantly based out west, as headquartered in Edmonton, and have worked our way to the east, we've also brought sources of capital that maybe do not have bricks and mortar in this market, and those lenders are looking to diversify their risk and want to lend to the east, and so they look to groups like ourselves to help put together good quality debt. And so we've been able to bring new blood to the market, essentially. So that's been a success for us, is provide creative capital. So from an external brokerage standpoint, it's lots of capital. Canada ICI, however, is we do have as well our own proprietary source of capital. It's roughly about $4.8 billion of capital that we can also bring to the market as an exclusive offering. And so that's made up of one side of the spectrum could be pension fund style capital, very sharp pricing, risk averse stuff. Maybe it goes up to say 70-75% of the capital stack. And then on the other spectrum, more probably more your mezz style, private debt, could cut a check within a week type thing, add additional top ups to the capital stack. So we can combine these lenders, if you are investors internally, and provide you with one offer from Canada ICI, which is one lender on title, one offer, very clean. We deal with the background noise with the multiple investors. So we are a lender and a broker. And then lastly, one of the big pieces which we'll be talking about today is that with CMHC, we're a CMHC approved lender. So Canada ICI is an NHA approved lender. Yes. And so with that, we're able to obtain the certificate of insurance on behalf of our clients. We can take that piece of paper and go to the market because we are a broker. As well, we can go internally and provide that exclusive offer to our clients. And so from a insured multifamily perspective, Canada ICI as a broker and a lender, we're essentially one of the largest lenders in the country in that regard. Basically
Makes sense.
Originating.
When you're lending $7 billion a year.
Yeah, we've been busy.
Yeah. You know what, too? Insane. Like it's good. I think just to touch on what you said, where you're bringing different capital from different markets, like Edmonton, Calgary, here, like especially in a market that we're in. I think it's important to have those tools in your toolbox because, like, for guys like us, and we're going to touch specifically on multifamily today. Like we need as many different options to present clients as we possibly can. Like it's not like it was before where, for example, we have a great relationship with First National where we're going to say, hey, First National, we already know where it's going to come in at XYZ. Here's the COI, here's the LOI. Like we can just go. Right now, it's like we have to be very aggressive and strategic and structure things properly. So chatting with guys like you, it's like it's very eye-opening, and I think we're going to learn a lot today too with what you guys have to offer. So
No, I appreciate that. And I mean, just to further that point on those types of the CMHC deals, is that how we kind of differentiate ourselves is the fact that, we don't ask for, a deposit up front, or, need some sort of confirmation before, we go and get the certificate of insurance. So we're not kind of handcuffing, if you will, up front. Basically, we'll gather the information, provide you with full transparency what we're going to submit. Once we get that piece of paper from CMHC, then we go to the lender community and bid. So that will then allow you to see what the lenders can do at that point in time, which will provide certainty, because at that point in time they can go to commitment because there's a COI in place.
yeah,
Now that CMHC is taking 4 to 6 months to get things approved, the lenders that are quoting prior to going to COI approval, those are all indicative. So whatever they quote today, it will most likely not be what they can offer in 4 to 6 months.
Yeah.
So they may not be the best lender at that point in time. So we give you that, almost like we treat you like an unrestricted free agent, if you will, in the sense that we go get you COI and then you get to go to the lender market at that point.
Is it locked in? Like how long can you guys lock it in for?
So depending on who the lender is,
Yeah.
they can hedge the interest rate for a period of time.
Yep.
So it really just depends on who you intend to proceed with. I'd say most clients are not necessarily locking in at the time of submitting to CMHC. It's when you get the COI.
Typically 30 days out, right? Is like
Yeah,
the
like
general guideline.
You want to get financing in as soon as possible. Then we can hedge for 30 days, no
Yeah.
problem. But if you wanted to hold that COI for 6 months, because that's the maximum amount of time you can, we have lenders that can hold for 6.
Yep.
So it just depends on where the market is. If we feel like rates are going to drop, maybe that's the play, is play the market a bit and hold.
That's what we did.
That's what we did. And that's a common misconception too with when we're talking to people that are like, they're coming from just a residential background. They have a few townhouses, whatever, they're pre-approved. They lock in their rate for 30 days or whatever the bank allows them to do. And then they come to us and they're like, well, how come I can't lock? I'm like, well, closing's in, 4 or 5 months. Like, one, do you want to lock? And two, like in commercial, it's a much different ball game, right?
Absolutely.
So there's been times too, like personally, where we've bought buildings and I'm like, hey guys, like if these bond rates keep going up, like we got to just lock it. And I remember on a deal we did recently, like we refinanced earlier this year, bond rate dropped like 30 basis points. I'm like, perfect, like whatever, we're going to just eat it. It's not where we want to be, but we're going to take out the majority of capital anyway, and boom, lock it in. Next day it shot up like 50 basis points. I was like, I'm the man, I'm in the market.
Yes.
And then next thing you know, it's like, well, it dropped like 80 basis points. I'm like, God damn.
Yeah.
And like, it hurts, right? Because like you're seeing it from a lender perspective too. Like 80 basis points is not a lot, but it's a lot in terms of like,
What
that's
you can
millions
pull.
depending on the loan, right? Like that's a
100%.
lot of capital being locked or unlocked. So
Yeah.
it's tough to hedge those bets, but I mean,
You'll lose a lot of sleep at night if you watch it daily. That's for sure.
yeah,
So you
I-
just have
that's
to-
why I don't sleep, Matt.
Yeah.
I'm watching it every day.
That's what
Yeah.
happens with crypto. Those guys, it doesn't sleep, right?
Yeah,
They
That's
don't
it.
have hours.
Yeah.
That's right.
I actually
Yeah.
I use the ICI website
Okay.
to look at the bond rates, and
Perfect.
like for us it's not so much. Well, I guess it is. Like we want to know where the bond is at that day, right? As best we can, so we
Yep.
can say, okay, if we have a deal here, if we have a deal, with about to be an offer submitted, like where do we need to be based on today?
Yep.
Or
That's
We look at it every day for sure.
If it drops, you got to call a client who's near the finish line. Hey, just lock it. Right?
That's it.
So-
Yeah,
And
exactly.
since we're talking about that, let's talk about the rates. Like, what kind of rates are you seeing today for multifamily, and where do you see it going?
Yeah, good. Well, great question, I guess. Especially
You have a
with,
crystal ball. I
Yeah,
hear.
yeah.
If anyone knows where it's going, it's going to be Matt.
Yeah, right. Yeah. I don't think we would be talking at a podcast studio in Gatton. We'd be charting on my yacht somewhere down south. Right? So,
exactly.
yeah. So to,
Yeah, just
obviously-
general guidelines, I
Sure.
guess. Yeah.
Yeah. So like, I mean, just to give you the where the rates are today. So the commercial mortgage bonds, as of today, it's roughly low 4s right now for the 5-year, and low 3.4, 4.3. Sorry.
Yeah.
4.3 for the 5-year, and then the 10-year slightly below that right now.
Yeah.
And just because it's inverted at this time. And so right now with lenders, depending on the loan size, the risk profile to it, they're typically providing some sort of lender spread in the 40 to 60 basis point range.
Yeah.
In that range for a decent size loan, decent size meaning say 5 million and up.
Yeah.
If you're below that, we've seen lenders that are putting spreads of 1% to 1.25%, right? So something meaningful, I guess. So that's where the rates are today on a CMHC basis. So you're still beating the market on a conventional loan,
100%.
And so there's a benefit for that on a go-forward basis. And so where are rates going? I mean, Canada came out with the inflation statistics. It has gone up last month, which had a spike in the bonds yesterday.
Yeah.
And so, it's inevitable that, we're going to get to the point where the Bank of Canada has to make another announcement at the end of October, and that's going to factor into their decisioning, whether they need to make another adjustment or not.
Yeah.
We're hoping that they stay still and let the market adjust, as opposed to trying to come in and correct mistakes.
Yeah.
But I guess we'll see what the year end brings. Most people are betting on the fact that they'll most likely make an adjustment upwards before year end. That's the sentiment at this point.
And I think too, for us, like we've heard, end of 2024 they're going to come back down. Mid 2024 they're going to come back down. Now we're hearing, well, maybe it's 2025 now, and then it's kind of all over the place, right? But
yes.
Just touching on the CMHC versus conventional, like we're talking about rates, and that's obviously a major factor. The other thing that people don't realize is conventionally, most of the time, unless you're private wealth or something along the line of that, with a normal bank called Scotia, CIBC, RBC, whatever, if you're going conventionally, not CMHC insured, they cap the amortization around 25 years, right? So with CMHC, we can go up to 40 years, and then in some instances up to 50 with MLS Select programs, which we can talk about today. But I guess where I'm going with this is CMHC is always changing that, and we've heard things like, okay, well, maybe they're getting rid of MLI, or they're not taking certain private lenders out. So if you can kind of touch on what's going on with CMHC right now and how we can adjust for stuff like that, I think it'd be valuable.
Yeah, for sure. Like, I guess I probably, for the majority of the listeners, are aware of the CMHC programs, but just to kind of maybe summarize it a bit. So roughly over a year ago, CMHC came up with this MLI Select program, and it was to take over a predecessor program called the MLI Flex to allow more options, I guess, in terms of spreading out cash flow or amortization. That was one of the key things, because we were in an environment where rates were going up, costs were going up. So in order to combat that, CMHC came up with this program where they essentially potentially extended your amortization from 40 years to 50 years. So that's what the new program allows. The MLI Select program is essentially trying to tackle three pillars of the national housing strategy. That's affordability, energy efficiency, and accessibility. So depending on how you score for this program will determine what type of loan amount that you can achieve. Amortizations, premiums could get lower depending on if you score higher. So,
and sorry to cut you off, doesn't it affect the debt coverage you can achieve as well? Like I've heard in best case scenarios, up to 90% loan to value or 1.1 DCR, stuff like that. So is that correct? Am I correct saying that? Or?
Yeah, so depending on within the MLI Select, you can do construction, purchase, refi.
Yep.
For the construction program, you can go up to 95%. Basically, if you get your foot in the door with this program with the bare minimum points, which is 50 points, you can get 95% loan to cost. Amortizations between 40 to 50 years. And if it's multifamily, then your debt service coverage ratio is 1.1 times. If you have a commercial component to it, so long as that commercial component is less than 30% of the gross building area and as well 30% of the lending value, then they will debt service that at 1.4 times coverage. Okay. So there's a little bit of a DCR test that they do. They separate the asset classes basically and value it separately.
Oh,
and so in
wow.
order for us to go through that process, you rely on guys like us to basically say, hey, get us a budget pro forma rent roll. We'll basically underwrite it via CMHC, provide you with that template to provide full transparency and show you where it would shake out even before we even go to CMHC.
Yeah.
That's, I mean, rather than wasting time and waiting for them to tell you,
you
guys have got the template, right?
We'll basically do a sniff test, right? Because, no one has 4 to 6 months to be able to find out if it's a yay or an A. So we provide a little bit of certainty, I guess, in a sense. Obviously, market dependent. If rates continue to climb, then CMHC might, adjust the loan amount accordingly, and maybe that'll affect the feasibility. So, but we have a reasonable certainty going in what is achievable.
So 1.1 DCR for multifamily.
Yeah, and
purchase.
so that's
That's pretty good. I thought it was 1.2.
Well, no, it's on construction, right?
anything that's MLI Select
Oh, yeah,
multifam is 1.1.
Yeah,
The
right.
MLI Select, sorry.
Yeah, and then for the commercial side, they test at 1.4, and then if it's, let's just say it's a senior res or student res, then it's 1.2 times coverage.
Yeah,
Okay.
that makes sense.
Yeah, so there's a couple different ways that they look at it. In terms of purchase refi, depending on how many points you score, your leverage will be somewhere between 85 to 95% loan to value or purchase price, and then amortizations between 40 to 50.
Yeah. So one thing we found out, and this was a couple of years ago now, is on purchase, I think it was 6 units, you could go 1.2 DCR. Anything after that, it's got to hit that 1.3, and then on refi, both are at that 1.3 DCR, unless you're in the MLI program. So I think where I was going again with this is like, do you see, like, this stuff is changing all the time, right? Like, we talked about 3 things that have changed in the last week with CMHC. So has there been any more talk about MLI being removed or maybe being changed? And then what else is kind of going on in the CMHC market? Like,
Yeah, so I would say that for MLI Select, because it's a relatively new program, there's always going to be adjustments, tweaks here and there. I think that, one of the things that came out of the gate specifically was the energy efficiency piece, where depending on geography, if you're, in the prairies or even Ontario for that matter, our climates don't really allow for us to be able to achieve higher energy efficiencies. Whereas if you're, BC region or even the Atlantic Canadas where you have better climates, then most of those projects are getting 100 points on energy efficiency alone. So they don't even need to tackle affordability. And so CMHC didn't really anticipate that, how many applications would be going in based solely on energy efficiency. So there might be a time, or maybe even now, that certain markets are just getting flooded with energy efficiency applications, and they're saying, our boots are full with this, and so, if you provide some affordability, we'll reconsider your application, something to that extent, but they want to maybe curb some of those requests. So there could be an adjustment to the energy efficiency. Nothing at this point has been mentioned. CMHC does review their programs annually, and then we'll determine if there's adjustments. This year they said it's going to remain as is. The intent is to keep their programs going until 2030, basically. That's the mandate, that they want everybody to have an affordable place to live by then. The government recently came out with statistics saying that they're going to be way behind that come 2030, and I think Ontario has probably the biggest deficit across the provinces for it. So more than ever do we need, or not we, but the developers need assistance in getting these programs suited for them to be able to make the projects feasible and work. As much as CMHC wants to be tenant first, which is fair, that's what they're mandated for. In order to have a tenant, you need a building. In order to have a building, you need a developer. So it has to also work for them too. So I think jumping back to one of your other pieces there regarding the 1.2 times, 1.3 times, that's for their MLI standard program. So it's separate from MLI Select. That program, you don't need to score any points for energy efficiency, affordability, accessibility. Basically, you just submit your application based on your current rents in place, and they'll determine how much of a loan they'll give you. So a little bit different than the MLI Select. I would say that more than the most program, probably the flavor of the year, basically. And the last year was MLI Select.
For sure.
So that's, if anything, we're testing everything on MLI Select because we can push on the amortization.
Yeah, we're hearing it a lot more now when we're talking to lenders. Like, it's, hey, maybe go in bridge debt. Like, I'll give you an example. So we've got a deal under contract right now. It's $10 million, really good location, like under 200 grand a door, and like prime AAA location. We went to a lender. They're like, yep, CMHC, we can give you $3 million. Like, wow. All right. Well, obviously that's not going to work. Yeah. Sellers don't want to do a VTB, like seller financing, vendor take back. So we're saying, okay, well, how do we make that work? Well, a lot of the lenders that we're talking to are saying, well, we can give you bridge money at, whatever it is, 9.7% interest only, and we'll flip into CMHC. We'll submit the application right away based on MLI Select, and, you know, do the takeout that way. But even then, like on a purchase of 10 million bucks, even if you get 7.5 million, whatever the number is, 9.7 interest is still a lot of money. So like, are you guys using different strategies like within ICI or some of the lenders to kind of, you know, make some of these deals happen right now? Are you being more aggressive with it, or is it kind of, that's just the name of the game right now, which I can fully accept?
Yeah, totally. To be honest, like I'd say if you're in that 7 to 9% range, I mean, that's just standard cost of business right now, unfortunately. And, you know, at 9%, I mean, that's prime plus 1.8, you know, reverse 3 or 4 years ago, that's a pretty good deal. But based on where prime was. And so right now for purchases, definitely bridge is the way that most people are leaning towards, because depending on the vendor, if they're willing to play ball, the best solution would be to an extended close. That would be the preference. But CMHC is taking 4 to 6 months on average to be able to get an application through. And so the unfortunate piece is that depending on the vendor, they may not want to wait for that, so you might have to get a bridge. That bridge lender may want a minimum amount of interest before they allow you to pay them out. So it could be potentially 3 months, most likely 6 months minimum. And so CMHC right now will allow those types of bridges in place for purchase. However, just recently, they've adjusted some of their metrics on refinances. And in the case of a purchase, not necessarily, I guess, a refinance, if you will, but how you would classify refinance with CMHC is anything that is an existing debt in place that wasn't a purchase related, right? So you had a property, you know, maybe for a year or 2 years, let's say, that you purchased, you've renovated, and you want to go to CMHC to put the long-term debt in place, essentially. Mm-hmm. So what CMHC has mandated very recently here, and this is going to affect a lot of people, is that they're going to want the lender that's being taken out, say the conventional lender, that lender needs to be in place for a minimum of 24 months. So
wow, they upped it. Because it was 1 year before, right?
So 1 year was you had to be 1 year stabilized and to prove it.
That's a disaster for a lot of people.
Huge.
Especially taking private money.
Well, on top of that, they won't allow the use of funds to take out private debt. So that lender has to be an NHA approved lender.
So if you have private money if you've borrowed private funds to purchase an investment property, and you want to get it refinanced with a conventional lender, what's the strategy there?
Well, you're hoping that you can find a conventional lender that can take out the private, and that conventional lender needs to be in place for 24 months.
Okay. Yeah. Sorry, man, I'm going to just take it back. So if you've got the private and you want to get out of it, you can't just jump into CMHC. You have to go conventional and then CMHC?
Unless, correct. Unless, like, for example, ICI is an approved lender. You're not necessarily doing private, but like you said, you have different funds. So if we said, hey, Matt, we've got this deal, we want short-term bridge money, we can get out of it in a year, and CMHC will take you out because you're an approved CMHC lender. So it really narrows the pool for a lot of people where, you know, even guys like yourselves, like, you can probably find us a lender that says, hey, we can do this in a week. It's going to cost you, you know, whatever, just throw out a number, 12%, right? But that's going to hurt a lot of people, I think, like you were saying, because a lot of the times I'm just going to a broker saying, hey, man, I heard you got private debt, like, just put me in, and there's a few
I'll get out in a year.
Right.
Yeah. It's you can't do that.
So the private debt refinance has been well known. I guess CMHC doesn't do that. So that has always been an issue. So we've always bridged the client with a conventional lender, say for a period of 6 months while we get CMHC in place. So that a CMHC approved bridge lender basically would come and take out the private debt as we're putting the CMHC application in. Once CMHC is approved, we take out that bridge.
Gotcha.
Now CMHC is saying that bridge lender needs to be in place for 24 months. And so that's one thing. That's one issue, right? Second issue is the debt that is in place has to be being repaid, principal and interest payments. It can't be interest only. So that 24-month lender has to be on a P&I basis.
No way.
Yeah.
Oh, that's risky for these guys going into these burrs.
Well, and so to put it in perspective, usually, interest only, you can kind of stretch out your cash flow a little bit.
For sure.
And it allows the lender in place to at least service the debt, right? So now you got to service the debt for 24 months, but on a principal and interest payments, let's say it's a 25.
You're getting torched.
Yeah, right.
Yeah.
So it's not going to service. So that lender's going to say, well, you're going to need to pay down that loan, right? So you're going to have to inject some equity to pay our loan down and keep that in place for 24 months to be able to, be refinanced with CMHC at that point.
Why do you think that is? Because that shouldn't, hypothetically, if CMHC is coming in, I've fully turned over a building, which we'll talk about, because whether a tenant wants to take my money or not, that shouldn't be, I think at least, it shouldn't be CMHC's problem. If someone is in a position where they want to take $5,000, $10,000, whatever the number is,
Yeah.
they should be able to do that. But anyway, that's besides the point. So I guess what I'm saying is you need, like, it doesn't affect CMHC at all, right? Like, if my building value has gone up $1 million because I put X amount of renovations in, I got the rents up, which is how they value these buildings. Like, why do you think they're doing that? Do you think they're doing it to curb people from sending applications right now just because they're overloaded, or?
Well, I mean, saying it without saying it, I guess,
Yeah.
is one thing. But the reason why, or the reason that they are doing it, or at least have indicated to the lenders, is they're trying to curb the renoviction. So to your point, if a tenant wants a certain amount of money to walk, then it's their choice, right? But they're basically curbing that because you're displacing tenants in the market by punting them essentially.
Yeah.
And then going in, adding value, and to be honest, that's the highest and best use of the property.
For sure.
And in reality, what you're probably doing is bringing that building up to code, because those buildings that need the value add or the love are probably in not disrepair, but obviously disarray.
Sometimes in significant disrepair, though, right? And
Sure.
They could be
health
bed bugs.
issues, yeah.
There could be so many issues, right? Like
Yeah.
it is the highest and best use to get those things up to date.
Sure.
Yeah.
Yeah, absolutely. And so, so they're trying to curb the idea of renoviction. However, and this is just my thoughts when I hear this, is that if I'm a developer, regardless of this 24-month rule, if I'm going to buy this property, I'm doing it for the exact same reason, to add value as quickly as possible.
For sure.
Right. And so if I have to be with now a lender for 24 months, CMHC is just delaying the inevitable. The same thing's going to happen. Renovation's going to happen, and we're going to wait for 24 months. We're going to go to CMHC.
Yeah.
So that time frame is the question mark, right? Like I don't know, this is me personally, but if I'm thinking out loud, I'm thinking, like, is this a PR move from CMHC in terms of, like,
It's a government move, right?
Right, like 6 months. Like if we're allowing this renoviction, and we're allowing for the refinance, then us as the government look pretty terrible. Essentially, we're supporting this.
Yeah.
Yeah.
Whereas if we're 2 years down the road, hopefully people have forgotten about this experience, and then we'll help the developer out.
So
Yeah.
So essentially, CMHC is the government, for those who don't know,
It's
and
government agency, yeah.
they're trying to stall the process of giving funds to people, because they don't want people kicking out tenants and kind of eliminating the affordable living of homes for people.
But
in a nutshell.
Yeah, to a degree, yeah. I think, without getting political, obviously, I think it's a different story if you're kicking these guys out and just leaving the building vacant, eliminating housing completely. But I think, there's got to be some better, solutions to
100%.
whatever CMHC is trying to do with this 2-year rule and renovictions or whatever, right? So
Because then they're contradicting themselves.
Yeah.
And they're going to stall the process of development, really.
yeah, it's like you said, like we, as you can imagine, we work with a lot of developers too, and it's like, to see what these guys are, like, the processes and everything that they have to go through is, like, it's crazy.
Yeah.
And then you have one guy in the entire city who decides, for whatever reason, I'm against this development, and he pays that whatever $200 fee, went out of his way to do it.
Right.
And he says no, and then you have to go back to council and explain to them why it's a good idea. Like, it just blows my mind. Like, it's like double-edged sword, right? You're saying on one hand we need this, but on the other hand, we're going to make it as difficult as possible.
Oh, absolutely.
So-
So it's, it's solving one of CMHC's problems, or like I said, PR problem, but it's going to create other problems as a result. And so is this the right way to do it, or is it going to create worse effects? So, by doing this is, like you said, it's going to hurt future development, because the idea is that that developer could have refinanced this sooner to be able to use those funds to go and either create new housing or do a similar process, bring maybe other projects in disrepair and bring it up to where it should be. It's delaying that process now because they won't be able to recycle their capital until CMHC's in place.
Yeah, and that's a huge thing, right? Like a lot, like kind of touching on that, like a lot of the guys that we deal with are developers that are saying, hey, we're going to build 55, 100 units, whatever it is, and we're going to sell it to, a publicly traded company or a private equity group. And then we're going to use that capital. We're going to go do it again over here.
Yeah.
Like exactly like you said, like if you can't read, like, what are you going to do?
Yeah.
That's 100 units that, maybe they even have the lot site plan approved already.
Yeah.
So that's like a year, 2 year process of 100 units that you just eliminated and pushed back another 2 years.
Totally.
Yeah.
Well, and so CMHC they've monopolized the situation because there's no other lenders that we can go to and say, okay, well, thanks CMHC, but we're going to go over here and do this, and something comparable is over here. No, there's no one competing against CMHC at this point.
You can't.
You
right?
can't. It's most likely if it's not CMHC, it's not happening. Unfortunately,
If it's not CMHC, the only other option is a massive vendor take back.
So yeah, exactly. You're getting creative in terms of that VTB, and again, if they're willing to play ball.
Question, Matt. Sorry, before I forget. Yeah. With regards to VTB, if you've got a VTB with interest-only payments, you could flip into a CMHC mortgage right away, can't you?
Assuming that, in a purchase scenario, absolutely.
It's not private debt; it's just a vendor take back.
Yeah. That is fine. Purchase and completion takeout. So once the project's complete and stabilized, and you want to go to CMHC, let's assume that you did conventional construction. You want to go to CMHC for the takeout financing. Then totally fine. They'll have no issue in terms of that 24-month rule. Purchases, same thing. 24-month rule doesn't apply. And however you get there, however you bridge basically to get to CMHC for that purchase is fine. It's really a true refinance scenario. That's where it affects. Okay. And so the other piece that I was going to mention as well, and again, this is not in the lender handbook yet. It's not something that is publicly of knowledge, something that shows black and white the rules. This is from us talking to our CMHC reps, underwriters, and again, because we're such a huge lobbyist against a huge group with CMHC, and we have a good level of respect and understanding with them.
Yep.
We have this dialogue, and all that we can do is capture this information, and we have our teams across the country that are also sharing and collaborating. And so I can share this with you because of what we've experienced, and we're experiencing it today. So this is something that is not going to be in effect. It is in effect, and it's actually almost even retroactive in a sense that if we've submitted an application in this refinance scenario to CMHC, it actually will affect that file once the underwriter picks it up. So it's not that, as of today, any files submitted to CMHC are affected. It's an underwriter could pick it up tomorrow and say, sorry, you're not meeting the 24-month rule. And so the other piece is CMHC underwriter is actually also requiring, and it might be underwriter dependent, I should say, but they're actually requesting for titles to be pulled so that the lender can prove that that loan that we're going to be taking out has been in place for 24 months. So they're doing their due diligence and ensuring that's possible. And so there's that. The other piece as well, because this can't get any worse apparently, but it can, is that loan that's in place for 24 months let's just say with the lender is been in there for 24 months, but let's just say 12 months ago, you took out a second loan with that lender or a line of credit or whatever that's on title. CMHC will see that and they'll say you cannot have the use of funds for that loan because it has not been in place for 24 months. So you could take out that 24-month loan, but that 12-month loan doesn't apply, and you're not going to be able to discharge that lender from that property as a result.
So they'll hold back that amount if it exceeds and you're able to pay out. They'll just say, well, we're just going to hold that back.
Yeah, and then the lender in place is going to say, well, we're not going to lose our position on the mortgage, on the security. So
So basically, if I go in, I buy a property right now, I say, okay, my buddy down the street has $2 million liquid. He's gonna lend me $1 million. I'm gonna have 200K. Like, so he's at, 80% loan to value. He's fully private, just my buddy, not on title, willing to lend it. I go to CMHC in 6 months or a year, whatever it is, say, hey, I need to finance this building or refinance it effectively because I've already bought it. They're gonna say no.
Well, if it's a free and clear property, right? Because
But if there's a private loan on it,
if it's a private loan on title,
Yeah.
then no,
Yeah.
they wouldn't allow it. Period.
that's
So
crazy.
you need to get a private loan. You need to get a private loan that's
Unsecured.
not on title.
Unsecured.
Unsecured.
So
On your house.
yeah. So calling mom and dad. So, but
That
it
sucks though.
And so, obviously we're finding out things as we go, because even with CMHC talking to the reps and everything, it's still unclear. So if the people that are putting these programs or these requirements out or policies out are unclear, then all of us are unclear until they figure it out.
Yeah, and it could very well, like you said, be a scare tactic or underwriter dependent and just, right? Like, I think the general consensus is it's not, like, this stuff is actually happening, like you said, like we're seeing
It's
it all the
happening
time.
to the files that we're seeing today.
Yeah.
And so that's why it's creating precedent. Yeah.
Wow. Well, hopefully they backpedal that one.
Yeah, well, yeah, and who knows, right? Like, it can always change. So maybe they might amend that slightly to be a little bit more flexible on a case by case basis. But again, it's to curb rent eviction. So maybe it's if what we're asking for is in fact creating that issue, then yeah, they're probably going to be against it. Whereas if it's a straight refinance, then maybe that rule doesn't apply.
Yeah, like maybe you buy a building vacant, right? And, I don't want to pay cash for it. Obviously, everyone wants to use leverage in real estate. That's the point. So we buy a building vacant. Hey, we use private lender buddy down the street. CMHC could say, okay, well, you didn't really displace anyone. The building was just in super.
Yeah, you brought new
Shitty
units to the
condition.
market.
Yeah.
Right. And so you've met their need, as opposed to create a headache basically with
Also,
certain
they
tenants.
would consider that.
We're hoping that maybe it's a case by case basis.
We've
right?
Yeah, we've heard that from a few other lenders. Well, I have. I
Yeah.
just totally forgot to tell you.
Yeah.
Like there's certain scenarios where, I mean, if the building's condemned and then it's just in terrible shape, like obviously you want to come in, like you want to.
Well, not even now. If
Bring units.
if they would actually allow that, then you can kind of restructure the deal for the owner to help you vacate the building before you purchase it.
Yeah, if it's
And
in
then pull the
disrepair for
trigger.
sure. Yeah.
Yeah.
And
See,
then,
yeah.
so you can kind of rejig the deal knowing that this product's available.
Yeah, and if the intent is to purchase and renovate, CMHC does have a program out for that. So I should mention that
Yep.
they're trying to also push developers into using their product for that, and ultimately it's so that they can have a piece of the control. So
100%.
they're going to make sure that you're not doing things that.
Do you find, and I was just thinking about this a couple questions back, but do you think CMHC not having any competition and being a government regulated agency, do you think that's a problem for, well, they're creating issues obviously with what we're talking about, but do you think having no competition is an issue? Like, do you think there should be another insurer out there? Because like in the regular residential space, there's CMHC insured loans, and then there's another, what's the other company? I don't know if you're familiar with
All right,
it.
on the retail side?
On the residential
The
side.
residential
just
side is
purely residential.
Genworth.
Genworth.
Yeah.
Right? So do you feel if we had a Genworth on the commercial side, it would kind of help curb some of these issues?
Yeah, I
Or-
think competition's healthy, right?
Yeah, 100%.
And I mean, whether
Otherwise
you
it's
talk about the
monopoly, like
cell
you
phone
said, yeah.
industry or the airline industry for Canada, right? I think it would help create a level playing ground. Now, I mean, to be honest, like CMHC, it has been a saving grace.
Oh, yeah, they've been great. I love them.
for the developers. So not to fully knock them. It's obviously just with these new changes. Obviously, there's going to be a lot of frustrations and a lot of hard conversations that we're going to have with
100%.
clients. But that being said, if CMHC wasn't here, most likely projects would have stopped over the last 5 years.
I 100% agree with you. Like, definitely not a knock to CMHC.
Yeah.
They've been great. Like, a lot of our loans are with CMHC. Like, it's an amazing product. I'm just thinking, like, okay, well, when you have total control like that, it can get a little dicey, right? So, I think, yeah, like, it'll be interesting to see kind of where this lands, because I'm talking to clients, and Jack and I are talking all the time, all day, every day. Like, I'm pretty much a second wife, but it's like I I don't understand how. I get the metric behind it, where they're saying, for example, like if you're like, okay, Justin, you have a building, right now CMHC is at 5%, let's say. We need at least a 5.5 cap or a 6 cap for spread. I understand the metric, but like if anybody came to me and told me they want to pay a 5.5 or 6 cap for any of my buildings, tell them to take a hike. So where I'm going is like, do you feel that you know, I'm sure you've seen these cycles before, so do you think that those values are going to drop that significantly over the next course of, you know, whatever year, 2 years? And obviously, again, you don't have a crystal ball, but just being through it before and seeing what you see in the market, like.
Yeah, I mean, trading will create an effect on values, right?
Yeah.
If trading starts to stall, then you know it's going to be a negotiation versus, you know, best offer, or it's not going to be a bidding war type of thing for this product anymore, right? So you kind of have to just go with whatever you can get. Obviously, appraisers are adjusting their valuations in their reports, and they are, you know, the cap rates are going up that we're seeing in the reports, and CMHC is going to lean on that third-party verification as well. And so if the loan amounts are being affected negatively, let's say, for the purchaser, then the purchaser is probably going to be unwilling to proceed on that basis. And so either the vendor has to play ball and reduce their offer, or reduce, the sale price, or they're going to have to come in with a VTB, and most likely a lengthy one.
5 or 10 at least.
Right? That's the new reality if you want that sale price to go through.
Yeah.
Yeah.
That's what we're seeing too, right? These VTBs are saving deals left and right.
Yeah, like we did a 80% VTB.
Okay.
Like
Yeah, that's great.
2 weeks ago.
Imagine that. No more bank, no more CMHC. You're just
You're the lender?
It's just the people with the people.
Yeah. Well, and that's the thing, right? So maybe that is the saving grace of the situation right now. But again, to be able to take out that VTB,
It's not sustainable, obviously.
Unfortunately, you're going to have to replace that with a NHA approved lender at some point, and then if you want to go to CMHC.
So even if it's over 2 years and they just own a portion, like let's say it's a $10 million building, it's $2 million of debt that the seller is holding, CMHC won't take them out.
They won't allow the use of funds.
Wow.
Right.
I'm like, I'm honestly, I know the answer and I knew the answer to that. I just keep going back because I want you to change your answer for me. And tell me it's all going to be okay.
What I'm hearing is not correct.
I wish I could, the same question 8 times.
I wish I could pat your back and say it's going to be just fine. But if the VTB is in place to bridge the purchase, then yes. Then it's a play that can be suitable. But if it's a 2-year hold, unfortunately, that's a refinance.
Woo!
Yeah. So.
Oh Lord.
Yeah, it's gonna. Yeah.
I need a break.
Yeah. People are gonna be bleeding cash.
It'll be an interesting situation with this whole refinance, especially in these the renovation value add plays. How we bridge to CMHC is going to be interesting to see how those bridge lenders adapt and assist their clients. So will they potentially look to extend their amortizations? Because 25 to 30 is going to be a tight thing to debt service coverage during that period. So especially if it's a bridge lender, it might not be competitively priced. So they may have to extend. We have conventional lenders that will go to 35, 40 years. So maybe other people will follow suit with that. Also, it'd be interesting to know if CMHC will define what's principal and interest. You know, could the lender set the principal at a fixed amount? So it's not necessarily truly an amortized principal.
I see what you're saying.
Maybe it's a lower principal, but we're collecting principal regardless. Curious to see if there's...
That's a good loophole.
Right? Just seeing if that's a possible way or strategy that meets their need.
Yeah.
Oh, what if you did that with a private lender?
Private lender has to be NHA approved.
Yeah.
Unfortunately.
Okay.
Yeah.
Stop searching for it. It's not there. I've already tried.
Yeah.
Folks, I'm
One
trying
of
to
these
find
points-
you a way to make money.
If we keep you on long enough, like say 12 o'clock at night and I'm falling asleep, I might say yes.
So it's no longer buy, renovate, rent, and repeat.
Yes.
It's now buy, renovate, rent, bankrupt.
Yeah, that's it. Yeah, or you get the vendor to bridge you at the purchase bridge you till CMHC is in place for their purchase plus renovation program, right?
Okay.
So the vendor may need to play ball for 6 months to get CMHC in place, and then you go through that renovation process with CMHC's capital.
Gotcha.
Yeah.
So So I'm sure you work with a lot of private equity groups or large REITs, kind of similar to what we do. So about, I don't know, what do you say, about a year ago, maybe 8 months ago, something like that, probably about a year ago, we saw all of these larger groups say, we don't want value add anymore. We don't want old stock. We want new concrete builds. And we're always like hearing about this stuff with CMHC or different stuff with housing, and we're like, I wonder why they're doing that, right? And do you think the reason they started to shift is because they caught wind of this? And I'm not, okay, well, now it sounds like I'm saying there's collusion. I'm not saying
Insider
that. I'm just
info.
saying, like, these guys are top level guys, and they always, like, they have full research departments looking into stuff like this, right? Where a lot of other people don't. So do you think that could be a reason why they shifted from old value add properties to new stabilized assets? Because even 2018, November 2018 or newer, there's no rent control, right? So that's, for sure, that's a component. For sure, the lifespan of the building is a component. But do you think this takeout debt could be a reason as well why they shifted so drastically?
Well, I mean, and again, all
Speculation.
yeah, it's all speculation, I guess. But in talking to a couple of my clients and on the REIT side, the reason for the switch from old stock to new is that if you're going to have to put some significant investment into these properties, are the REITs aligned with doing that type of work, or do they want to flip it and find something that's just clipping a coupon and just easy and, like you said, out of rent control?
Yeah.
And so they're just looking to upgrade essentially.
Yeah.
So that's
We've been hearing that too.
That's usually the motivation for them is to sell this value add play to someone else that could make it work at a good return on sale, and then take that and put it into a purchase. Now, I've also seen REITs that are shifting towards constructing as well.
Partnering, being the capital partner.
Ryokan.
Yeah, absolutely. And so because it's almost cheaper than purchasing is building your own in certain situations. So we're seeing a shift in that as well.
Gotcha.
Yep.
All right. So, Matt, I think a lot of people have probably seen in the last, probably less than a week old, but about this new GST program that the government has put in place to kind of help save developers on tax dollars or make some of these projects work. Can you elaborate a little bit more on that?
Yeah, like in terms of what we know thus far, nothing has been kind of formally announced that outlines it. But based on what they've given us is that the GST is rolling out essentially to help developers in terms of reducing their costs, and hopefully that will relate to reducing rents for tenants and stuff like that. Whether that actually happens or not, we'll be in the details. But that GST rebate essentially will, at the back end of the project, when the project is complete, stabilized, and the first tenant takes occupancy, basically the city official will come out to assess your property and give you a one-time tax grab, basically to pay the GST, the self-assessed GST portion. And so what's going to happen is it's basically a rebate that will go against whatever they were going to charge you. So in the past it would be roughly 32% rebate. Now they're saying we're going to ratchet it up to 100%, assuming that you hit certain metrics. And so that they will outline that in the coming week or so.
So it's not just a free thing like, hey, build this property, we're going to give you 100% tax
That's it.
rebate.
It has to be multifamily. You have to have, I think, like 4 self-contained units minimum. If it's standard rental, if it's student housing or retirement, you'll have a certain amount of doors that you need to achieve there. 90% of the units have to be long-term rental. So there are some requirements for it. So that part there is the GST piece is great because that was a line item in the budget that needed to be accounted for. However, if the debt servicing for your loan is dictating what the loan amount is going to be, meaning that you're not hitting 95% loan to cost. Maybe it's 85% loan to cost because your budget is just creating that. It's too high. We can then take that line item, reduce your equity requirement, and maybe get you closer to that 95%. So that's a saving grace. So it is a benefit there. Now, if you are achieving 95% loan to cost with that GST line item in your budget, we could potentially maybe reallocate that to contingency. So at least
Yeah, I was gonna say for sure.
you could use that if and when it's required, but at least it's built in, so it's not something that's a sunk cost now. It's there for if you need it, and then if you don't use it at the end of the project, at least you have some quasi-equity repatriation, if you will, that you can utilize for the next project.
Yeah.
So it's a benefit. Now, that's the feds have announced this. Now, each province also needs to buy into this. Now, Ontario, I think Newfoundland, out west as well, have all bought in. Recently, Quebec had announced that this program may not be a good fit for the province, and that I think they did a calculation, said that it's going to cost them about $1.5 billion to be able to make this thing work, which sounds like they may not proceed with it, and they're going to look at alternative solutions. However, I'd be curious to know, is that a cost-benefit analysis, or is that just looking at what the costs are? Because are we leaving out the benefits of the GST or the tax revenue, that we would receive from the building, tax
Property
revenues
tax,
from
yeah.
the tenant migration that would be as a result of building this new product. So that would be something that I'd like to have them further define.
Yeah.
Yeah.
You would think it'd outweigh, you know what I mean? Like,
Right.
The benefit would outweigh the
100%.
Yeah.
Yeah.
Wow.
Well, this is, I mean, it's a good incentive. It's a good try for them to
Regardless,
help developers.
it's a positive.
Yeah,
for sure.
considering they've got 3.5 million homes needed by 2030.
Yes.
That's a fact. I read that today.
You just read it now.
There you go.
I think.
Yeah. Oh man. And so another thing we've been anticipating is potentially more power of sales in Canada, because of obviously the increasing rates, and people who bought a few years ago didn't anticipate the rates going up significantly. So, are you seeing anything on your end with regards to power of sales?
Yeah, I would say that a lot of the existing mortgages that were, let's say, booked 5 years ago at much lower, say, half of what the interest rates are today, maturing, are now being tested by the lenders at a higher rate on the outstanding loan amount, and it's not debt servicing to their standard or need, the minimum debt service. And so they're coming back to the client and just saying, hey, either you pay us down or pay us out, and putting them in a difficult situations, because they're kind of forcing them into a power sale if they can't find another lender that will take on that risk. And so we're seeing it a fair bit.
Yeah. So those numbers are going to most likely start pumping compared to previous years.
And I'm sure that's on the residential side as well, not just the commercial multifamily side. Like,
I think, to be honest, I think it's across the board,
Across the
whether
board,
you're
for sure.
whether you're any asset class, you're single family home for that matter, right?
yeah. Shout out the broker that told me to take a 1.8 variable.
Nice.
You know who you are.
Live dangerously.
Yeah, exactly.
Yeah.
I was like, whatever you think, just let me. I'll just sign it. And
Yeah.
I'm looking back. God damn it.
Yeah, those variable rates are horrible. Even fixed, man. I took my fixed rate a few years ago. It's going to be due in 2 years.
Yeah, I think.
What are the rates going to be in 2 years?
Knock on wood, you're going to be golden.
That's it. Well, I
It's
mean,
not going back to 1.9. I'll tell you that.
Well, it
No
doesn't
way.
matter.
yeah, I mean, unless if you're predicting another, COVID
COVID?
lockdown or something like that. But
I will go to the just worst jungle in the world and bring COVID here to get that rate back down.
that's it. Yeah, exactly.
Sorry, you were saying something.
No, I was going to say that. I mean, in the current interest rate environment, it's not sustainable,
Yeah.
and everybody's aware of that. So right now, it's fear, and that's what's kind of driving up things as well. At some point in time, things will settle. Things will have to inevitably come back down. And so, to your point, is it a year or 2 years? At some point in time, it will adjust back to those levels, and we'll be looking back at this and just saying, maybe next time let's
Just
not
a blip.
Yeah, it's a blip, right? And
Yeah.
and maybe we won't do that variable next time. It comes back.
You can tell me.
Don't do variable.
Yeah.
I'd be
Yeah.
so happy to see 3 again. 3%. I just want 3% back.
Well,
Yeah.
That's it.
I'd be happy with like 4.5, 5 right now.
Yeah.
All right.
Well,
this
thanks for
was
coming
awesome.
on, Matt. Yeah,
Yeah,
appreciate
Thanks
it.
a lot.
No,
I
thank you,
learned a
guys.
lot for sure. So, hopefully we can do some business, and we'll chat offline about some stuff we have, and yeah.
For sure. I'll definitely be watching this podcast. All right.
Thanks, guys.
Thanks.